This is the Leadership in Insurance podcast, brought to you by FinPro Search Partners.
Insurance companies are businesses and they need to look for the long term and be sustainable.
We went from 0 to 1 and now it's going from 1 to 100.
Insurance as a concept, as a kind of service, is brilliant. The execution is what we're looking at now.
I think the companies that are going to succeed are the ones that are going to understand and master the art of intent.
When we talk about innovation, we lean too heavily to think about technology and we don't think about creating a culture of innovation.
I think innovation is essentially continuous improvement of existing processes and platforms and product.
Right? It's got to be easy. It's got to be seamless. Good morning and welcome to the Leadership in Insurance podcast. I'm your host, Alex Bond, and I'm very lucky today to be joined by Jon, who is Director of Cat Response at CoreLogic. Jon, welcome to the podcast.
Thanks so much for having me, Alex. Glad to be here.
Yeah, good. Thank you so much for coming in. Say that like we're meeting in the room. It's a good room.
Exactly.
We're not, unfortunately. It would have been nice. Although you'd be dealing with this awkward sunshine that I'm dealing with here as well, which is going to be a feature of the pod as I get much hotter. But look, I'm digressing. That's what I like to do. Jon, I think it's really good to set this out. I think we're going to have a really interesting conversation, particularly around this report that you and your teams produced at CoreLogic. But before we dive into the kind of detail of that, it'd be really great if you could introduce yourself and your role and obviously, I'm sure lots of people know CoreLogic, but just so they don't, the CoreLogic business would be great.
Of course. So, like I said, my name is Jon. I've been the Director of Catastrophe Response here at CoreLogic for a little over 2 years now. And my role at CoreLogic is to manage our response when there are big ongoing natural disaster events. So, for example, I am sure people are watching Hurricane Debby making landfall just this morning in Florida. Fortunately, in this case, just a Category 1 storm made landfall in a very remote part of Florida, much like Idalia last year. But as a catastrophe model vendor company, right, we have the ability and the tools to estimate the wind, flood, surge, losses from an event like any of these hurricanes. So I oversee that response, making sure our numbers look good, making sure those numbers get out into our clients, to the media. And when I'm not doing catastrophe response, I'm helping a lot on the thought leadership of the insurance business unit within CoreLogic. So CoreLogic, we do everything, all things property related, that's models or data or tools, what have you. In the insurance sector, that spans from underwriting, risk scores, to claims management, applications, what have you, systems for watching live weather events. And then we have our stochastic, fully probabilistic catastrophe models, 180 peril models across the globe, including U.S. hurricane, which is the one I've been dabbling in just this morning. When I'm not doing event response, it's a lot of the thought leadership, things like these reports, like the risk report that we're going to speak about today.
Great. Thank you so much. I'm going on. This is flashing me. First question, completely off topic and not on the questions that we agreed.
Perfect.
This is selfish because I was asked this about employer branding, and it speaks to that. I think you talk about thought leadership, and I think that's a thing that obviously this isn't a branding exercise. This is a kind of an in-depth report that you've produced. How important do you think it is to sort of involve yourself in thought leadership? Because I'm thinking from a perspective of, CoreLogic's a big player. It's been in the game a long time, but I think people expect thought leadership from technology providers, data providers now, and that appears to be just part of the doing of business. How important do you think it is, and how do you kind of make room for that, which in a business where that's essentially a long-term play, is a long-term business development strategy or marketing strategy? How do you make sure that you've got room for that, and how important do you think it is?
I think it's incredibly important. From a business perspective, right, it keeps your name in the conversation when you're talking about in the insurance risk modeling space, obviously. But on a more public level, right, there's a lot of information out there on things like climate change or inflation or natural disaster activity, and obviously some sources are better than others. So it helps to publish things like thought leadership. It's just to have good information out and available. It's not sales material in any shape or form. This is, hey, we're talking about the El Nino Southern Oscillation phase and how it's switching from El Nino to La Nina, what that means if you are an insurer focused with writing, admitted lines in Florida, for example. What's going on with ocean? These things are important to just write about to make sure that the good information is out there, relevant information, and of course, we want people to think of CoreLogic as a preeminent cat modeling insurance focused organization. So it accomplishes both efforts. It is both long term, right? It keeps you in the conversation. People can come back and reference old material. That's amazing. And it's also really important in the short term because when there are developing stories that require research, when I do these event response things, right, I do my research. I look back for historical events that are good analogs for the current earthquake or hurricane or wildfire, what have you. Making sure there is good information out there readily available to anyone is incredibly important in the here and now.
Yeah, I agree, and I suppose, and I suppose where I was coming from as well. I think we see these things, and sometimes I see them, and I think they're done quite cynically, and they're quite surface. And I think the importance is, if you're going to do it really, really, really well, do it in depth. Or I don't see people sharing it or doing it enough, and I think sometimes that's where smaller organisations don't have enough time. It's a bit like Google's got this most famous principle about giving people, I think it's 20% of their time that they can just code R&D projects, and you go, yeah, that's great, but we run a 6-man search firm, and I'm not sure that I could give everyone a week off to just kind of do like creative projects. But no, I agree. I mean, I think it's important, and also it's kind of I think about talent. Presumably, it's quite a rewarding part of your job as well. Is giving into that stuff as well? Yeah,
absolutely. It speaks to I think there's a way to build trust, right? You can be transparent in your thought leadership. You're not publishing the model documentation, obviously, but you can give some insights into what is happening in the world using, information from the tools you have, and it builds trust with, right? Consumers of catastrophe models are the insurance companies. It's not the individual homeowners, but their rates are directly affected by things like model output. So if they are more confident in the models and the science behind the models and the assumptions made within the models, it benefits everyone. And you can demonstrate that through thought leadership. So it's a great way to build relationships, even with people who aren't going to be direct consumers of your products. But, we would like it if, people, if they're thinking about their wildfire risk in California and they go, oh, well, CoreLogic talks a lot about wildfire risk in California. Let's see what they're saying. So I really like that connection to even people who aren't clients of CoreLogic, just readers out there looking for information.
Yeah. Totally agree. I always say, trust me about the things I say that you don't like about executive surgery. That's where the real juice is. The things that I say that you might like about it aren't useful. Talk to me more broadly about we're obviously going to talk about this 2024 hurricane risk report. What other kind of types of natural disasters does CoreLogic track? And probably, we always talk about data in this kind of like really kind of nebulous way, but what type of data do you use to compile these reports?
It's a good question. So the reports are focused in the United States on probably maybe three of the four largest perils that are loss generating. At least three of the largest insured loss generating in the U.S. So every year we do a hurricane risk report. Gets released as close to the start of hurricane season as we can. We do a wildfire risk report that our wildfire risk report in 2024 should be released just about a week from now. And then in the spring, in late February, early March, we do severe convective storm. And we have severe convective storm has been, stealing a pun from wildfire conversations, but it's a hot topic especially in the US and in Europe, because insured losses from just severe weather they're up since last year and this year, right? It's been a problem. So we focus on those three in the U.S. It's not that we don't think about other perils. Like I said, the catastrophe models span the entire globe for most perils, especially in those regions where there's a developed insurance market covering those disasters. We do a lot of thought on European windstorms, right? Those have been, right. We've had a lot of close calls in the past couple of years. So we've thought a lot about like what could have been if Kieran, for example, was a little farther north, and instead of that kind of area, Brittany in France or the Channel Islands being hit harder, it was much closer to London. Well, then we're talking about a much more serious event, like the 87J or something like that. But in terms of the data, we're actually really lucky here at CoreLogic. I'm lucky because I get to use it on a regular basis. But when it comes to data and property data, so one of the reasons we focus on the US for these risk reports is because in the US, CoreLogic, one of our bread and butter, one of our biggest sources of analytics, is a data set essentially on all of the residential properties in the contiguous US. So, not just locations, right? We know how large the parcels are, how large the structures are, if there's extra structures on site, year built, roof age, roof update, materials used for construction, roof attachment types, right? First floor elevation, first floor height, obviously incredibly important when you're talking about flood. So to have this really detailed, essentially exposure data set, right, means that when we're talking about estimating the level of risk in the entire US for a peril or a particular region, we have a really good understanding of what is there that can be damaged. And that's the kind of information we leverage in combination with our hurricane models, our storm surge models, severe convective storm, wildfire models to generate these risk reports.
Take us into this report then, and this is a really big question, John. So I appreciate you might want to break this down, back to me, because it's a pretty comprehensive report. But maybe just explain some of the key takeaways, key trends that you saw in 2024, and probably essentially for context, how does that compare up against other timeframes, previous years, etc. Which I'm sure you will. But I think that's always interesting. Is the kind of direction of movement is probably more what's interesting, particularly in this type of data.
Absolutely. A couple of great points there. So, right, the goal of these reports is really to take a measuring stick and let's measure how much risk is there in the US for a certain peril this year. So when we think about hurricanes, we're looking at hurricane wind and storm surge flooding risk in the US. And we overlay our risk score models over that property data set. And we can say that there's 32.7 million residential properties, and that's single and multifamily up to 4-unit kind of places. 32.7 million residential properties, that's from Texas to Maine, with a combined reconstruction cost value of $10.8 trillion. And by reconstruction cost value, I mean, this is like how much it would cost to rebuild these homes from 0 to 100%. This is materials, it's labor, and that's other data feeds within CoreLogic feed into that reconstruction cost estimation. It's a piecemeal estimation from how much wood and how much tile and how much whatever you need to rebuild these homes. That's a pretty outstandingly large number, 32.7 million, $10.8 trillion. Now, that is just that's how much risk there is in the entire model domain. Are all of those homes going to be hit by a hurricane this year? Obviously not. That would be crazy. A lot of those homes are up in, I live in Boston, Massachusetts. We have hurricane risk up here. It's not the same hurricane risk as you have in, say, Miami, Florida, or Houston, Texas. But it is important to think about where these risk concentrations are, even if they're not the ones at the top of your mind, because the biggest changes we're seeing year over year in the past 5 to 10 years, maybe since the pandemic, essentially, is that in the US, people are moving, and they're moving away from the areas, the more densely built coastal cities, right? And they're looking for areas with maybe warmer climates. I wouldn't hate warmer climates myself, more space, cheaper cost of living. And these areas are not in New York City or Los Angeles or San Francisco, right? These areas are across the Southeast United States or in Florida or in Texas, areas where you can get a lot more home for your money. And that's why people are moving there. That creates an issue because where you used to think hurricane risk was concentrated is shifting, right? So more people are moving to coastal Florida. What you thought was, X million homes and X or Y $1 billion of insured value might be a lot higher than you thought because of these big migrations in people. And to top it off on that, right, we're moving to these areas, we're building nice big homes. And with the rising cost of materials and labor, right, things are more expensive. So the homes are bigger, homes are more expensive, and the repair costs are going to be higher. So our old fundamental ways of thinking about where risk is concentrated is changing as people change, as they move to new places. And that's what we try to capture every year as we do these reports and we think about hurricane risk in Florida versus New York versus Texas, right? This is how the risk is shifting geographically.
Mm-hmm. Mm-hmm. I think the thing that I wasn't aware of is, and I hadn't probably thought about, I was just thinking about, when I thought about this report, I thought, oh, it's just going to talk about climate change and the impacts of that and the changing kind of weather patterns. But the texture of geographic movement, human movement, people kind of decisions on kind of where they live and how they live and how that impacts this data, and obviously risk from an insurance point of view. Is that the thing that's probably been the most? Maybe I'm being naive. I mean, insurance people are pretty smart. Insurance, it's quite funny when we talk about data because we're talking about a lot of insurtech and the amount of insurtechs come on going, oh, insurance companies are really bad with data. It's like, I said they're pretty good with data, and for a long time now, they might not be the most sophisticated new forms of data set, but the idea that insurance companies are not good or innovative with data is kind of at odds with what I think is true.
Absolutely. I mean, they wouldn't be making good business decisions if they didn't have good data to back those up, right? There's a reason why we have these models and tools, because there is data to support them, and we can make well-informed decisions with that data. To say they're uninformed, I think, would be false. Yeah. As the data and technology gets better, they might move from being underinformed in certain areas, but being even better informed in others. But you brought up a good point. When we think about risk, right, you need three things. I'm going on a little bit of a tangent. Hopefully it's not a problem. But I have a great friend from college who teaches 7th grade science here in the States. And I go in once a year and I talk about some natural disaster and risk. And I always put up a slide that shows in the center of the screen, it says risk. And I say, all right, what three things do you need for there to be risk? Right. And then they'll yell a bunch of random things. They're 7th graders. They have a lot of sugar in their system. So sometimes they're yelling a lot of things. But right. So you need natural disasters. Without natural disasters, there's no risk. Things like climate change are changing the nature of natural disasters, but that gets kind of factored in. So you need natural disasters. But you go up to, right, in Canada right now or in Alaska, a lot of wildfires in Canada and Alaska. Is there a lot of risk in a lot of parts of Canada and Alaska? No, because there's not many buildings. So you need exposure, right? So you need disasters, you need buildings, and those buildings have to be vulnerable to the natural disasters. So when we start thinking about risk and how risk is changing year over year, of those, three factors, what are the biggest drivers? Climate change certainly is taking effect on natural disaster activity. It's different for each peril, and the level of confidence that the IPCC has in how climate change is affecting hurricanes versus severe convective storms versus floods varies, right? There's a lot more confidence in like rainfall-induced flooding, right, with climate change, right? If the air is warmer, it can hold more moisture can hold more heat, therefore can hold more moisture. You're going to have wetter storms. Sea levels are higher, storm surge is going to be worse. They're pretty confident about that. Or the proportion of these sort of category 3, 4, and 5 hurricanes relative to the total number. So there's high confidence in that. Not saying there isn't a connection, it's just the connection is not well defined between things like climate change and severe convective storm. It does create the conditions for storms to, right, the more moisture and the more heat you have in the air, the more instability, the higher likelihood of a severe weather event. But to say there's like a one-to-one connection between it getting warmer globally and severe convective storm activity in one point at one spot within the US, it needs to be studied more. So climate change is there, but the biggest drivers in the here and now, in the short term, right, is exposure. It is where people are moving, where they're building properties, where where the insured value is, and the sort of sneaky hidden driver is the cost of repairs. Claims that would have been, I don't know, $1,000 for some roof work are now $3,000, or maybe needs a new roof and it's could have been a $5,000 or $8,000 investment is $15,000. Multiply that by 1 million homes, or however many homes were impacted by category 5 winds or hail greater than 3 inches, right? These per event losses are higher than they had been previously in for the higher frequency events like severe convective storm, right? That's starting to take a pretty big toll on the year-end loss reserves.
Mm, mm. I love your segue. So I think it
Yeah,
explained it really nicely.
of course.
Which shows you the education level of the people listening to the podcast. Seventh
Mm.
graders. That's what we're
Hmm.
looking for explanations for. No, I think that's the thing. The exposure was the thing that I didn't think about when I was going into this report. Yeah, it might be uneducated kind of mindset. I mean, we talked about my knowledge of natural disasters. I know P&C pretty well, but like
Hmm.
not thinking about things from that perspective.
Yep.
What are insurers doing with this data? What does it mean to them? Because presumably their response is different per carrier, right? They're not all going to respond in the same way. And this is a bit of a follow-on question, but is anyone doing something really innovative with this information that you've seen or you've been exposed to?
I think the one of the things that the reports like this highlight when we're talking about content is identifying these areas and concentrations of risk. Maybe there's a carrier out there who was writing in parts of coastal, Mississippi, Alabama, the Panhandle, and they'd been operating fine over the years, but didn't realize just maybe how much risk is building up there as people. Maybe they didn't realize more and more people are moving to these areas and building new homes, and they're just keep writing their new business, and all of a sudden their risk concentrations in certain areas are getting a lot higher than previously thought, and that might influence their underwriting strategy. Maybe they need to start writing elsewhere for other perils to balance out that risk. And make adjustments. So when we put out these reports, it is to talk about risk this year, right? Are you thinking about your risk to your portfolio every year? Because it is adapting and changing year over year. It's a really big consideration for things like wildfire, right? In California, and that's what one of the things that carriers are having problems with in California is these sort of areas of high risk concentration. It's not. It's that for wildfire, it's a different peril because, right, the homes and the concentration of the homes influence the peril's destructive activity. So if you think about flood or hurricane, right, the wind's going to blow and the wind's going to blow. The wind blowing on my neighbor's house isn't really going to affect the wind blowing on my house. But if my neighbor's house caught on fire, it can have a pretty big direct effect on my house. And if you have a lot of homes built in a very close community without built-in community level fire defense systems like fire breaks and not a lot of people focusing on the individual mitigation efforts they can do at their home, that creates these concentrations of risk. And that's what we're trying to identify with these reports, these areas of high concentration of risk. And these are the areas you have to think very critically about. We're not saying abandon, right? That obviously is a problem with people pulling out of certain markets and policies dropping. But if you can identify the areas of high concentration of risk, and if you have a good understanding of the individual building characteristics that influence vulnerability to these certain natural disasters, then you can do things like change your underwriting and pricing policies to account for the risk and to continue writing and providing coverage to these people who live in vulnerable areas and need insurance coverage. So when we talk about what we want carriers at the primary or the reinsurance level to think about is, right, these are these areas of risk concentration are extensive and shifting slightly year over year. So let's keep an eye on it and let's not let it sneak up on us because, right, as we learned in 2022, right, it only takes one bad hurricane to alter loss ratios at the end of the year. You get a Hurricane Ian kind of event rolling in through Tampa St. Pete. Now that is typically an area of high concentration of hurricane risk, so not so surprising. But could have been other parts of Florida that people are moving to out maybe in the Panhandle. And if that was a Category 4 hurricane, could have been a substantial loss that maybe people weren't expecting. So that's what we want these carriers to kind of take away from these reports is knowing where risk is.
I'm intrigued to what you might think about this. I mean, we have lots of insurtechs on the podcast, and the general theme, I think it's just not actually just insurtechs, but the general theme of a lot of kind of new insurance offerings are this kind of like proactive approach to the risk management, and not saying that insurance is the be all and end all. Insurance is one part of. I remember talking to V8, who's the CEO of Resilience, and it's a cyber play, and there's three different parts of the business, and they describe themselves as a kind of risk management business for cyber. So you've got, threat analysis, threat intelligence. You've got a SaaS proposition that defends you, and then insurance is just the end. It's the stop for when things have not gone to plan. this sort of data and this is the granularity of the data that you can pull leads itself really nicely into kind of that type of kind of coverage. Especially when you've got carriers pulling out of entire markets, you're thinking, is there not feedback loop to the customer? I mean, I know the customers in your case is carriers, but on the individual level, the policyholder, there's not a feedback loop there. And are we seeing that in this space, or is it I don't know if it's too complicated, or
I think people are
yeah.
it's a great question. I think it speaks to this concept of mitigation, right? And that's your first line of defense
Sure.
At the individual homeowner level when it comes to natural disaster. So yeah, insurance is a necessary tool in the recovery process. That is why the insurance industry, sort of developed as it did years ago and has expanded to where it is now. Because natural disasters are not going to stop. We need homes to live. They're going to need to rebuild. The best thing we can do is prevent natural disaster loss ahead of time. Now, we can't stop the disasters from happening necessarily, but what we can do is we can mitigate the damage they do. And that's when we speak to the homeowners, we're talking about leveraging technology to account for mitigation efforts so that it ends up getting reflected in your insurance premium. So not only are you going to save dollars every month when you're paying your insurance premium, but it will minimize the losses you'll take on. And when we're talking about hurricanes, we think about things like roof age. So in Hurricane Ian, for example, in 2022, right, the wind loss in Florida were not as high. Currently, what the Florida Office Insurance Regulation estimates incurred losses in the $30 billion range at the moment. Can't remember. I think that was updated in April, if I remember correctly. And we were at the point after landfall, right? People were talking about Hurricane Ian as Andrew, like this was going to be one of the worst insured loss events in Florida from a wind perspective. But what we noticed was a lot of these homes that have been updated or rebuilt or built in the past 10 years weren't sustaining all that much wind damage. You didn't see a lot of tarps on roofs. We captured a lot of that information was captured via satellite and aerial imagery and gets processed into the data, right? That's how we know these roofs are going to be, if we know these roofs are built within the last 10 years, we can see and we can model that the damage is going to be, is not going to be as severe at these homes. And it's a great way of leveraging these companies out there that have built these AI ML algorithms that can read aerial imagery or satellite data. And we can say, well, look, this roof, right, was built in 2018 and is in Florida, right? We don't expect wind damage to be all that severe, even if a Category 4 hurricane makes landfall not all that far. They very easily could withstand 130, 40, 50 mile per hour winds. The insurance companies are capturing or are paying attention to that information. It is available. There are companies, insurtechs out there that are providing that. We capture it in our exposure data sets as well, and it is reflected in the model results. If it's reflected in the model results, then it is reflected in your insurance premium. You will, if you mitigate, if you elevate your home, if you use a Class A roof, if you clear the brush away from your home, you have a storm, an impact ready roof or garage door, and you live in the Midwest and you're worried about a severe convective storm. These things are effective. The models capture their vulnerability, and there are companies out there that are capturing that data, and it's reflected in the data that makes up your home that goes into the model. So it is a great. It's the place we live now within in 2024 in the insurance world, right? There are so many tools and data streams at our hands, and they're making a huge contribution to modeling and accounting for risk.
Yeah, because I think that's what I'm excited about. I'm excited about this kind of new way of looking at risk management. We've seen it in cyber a lot. We've seen it in health insurance. It's been a big thing, isn't it? Like, we'll pay for your gym if you reduce your premium if you go to the gym 5 times a week or whatever. I never set mine up for some reason, but I've got the right in health insurance.
Leaving money on the table, yeah.
I am leaving money on the table. It's a thing I do quite often. But it's a trend we see, and in property, it's just one of those things where I've been surprised how slow that, like, we've got the data and we haven't seen it trickle through, and you've seen it in your kind of premium reduction. But I think people are interested and they're engaged, and people want to be able to mitigate the risk and feel a bit more control of that, particularly if they are moving en masse to these areas where there is a bigger risk. I don't want to extrapolate too much because I think I'm going off on a slight tangent, but I wanted to ask you really kind of probably what's next. 2024, we've talked hurricanes. Have you got any kind of thought pieces in development? Are there things that are just interesting to you that you kind of want to explore for kind of some of these further thought pieces?
Yeah, absolutely. I mean, so for these risk reports, obviously, we're always thinking about the risk this year, and that's going to leverage the new data and new tools that are available to us. I get really excited, and we're starting to, look into leveraging these AI reading weather data. This is sort of a new trend I've noticed popping up in just the last couple of years. I know Google has one now that I saw pop up on my feed, and there's companies out there that are trying to essentially predict weather events using artificial intelligence. So, historically, what we've done is we've created algorithms that can process radar data, that can sort of outline where we think wind and hail and floodwaters were. We can calibrate those footprints, those intensities with public reports that are made available. They're public reports, so you have to take them with a grain of salt. But for the most part, you think, law of large numbers on average, it probably works out pretty well. But if you can start predicting where this tornado is going to go before it even really forms, right? That's really cool stuff. We talk about notifying your policyholders ahead of time. The National Weather Service does it at the county level. I believe alerts are at the county level. CoreLogic, we've been working on doing that at a bit more of a finer granularity. But if this is like, we're reading and processing the radar data. But if that's already being done in real time by a computer with a brain so much larger than our entire organization combined, right? This is incredible stuff that it can be doing. And we can say, like, when a hurricane like Ian was still south of Jamaica in the Caribbean, we saw these original cone of uncertainties, right? And that was like all of Florida. But what if, we can anticipate the landfall location 7 days before it's there, before it's, even crossed another island, right? This is it for the insurers, right? It's talking about notifying policyholders, getting resources in place to rebuild quickly and efficiently. That's claims in a nutshell, is quickly and efficiently. But think about from an emergency management perspective, right? When you talk about evacuations, right, from these large events, things like the computing power that we have to make predictions is incredible, and that's one of the things I'm really excited for, is leveraging now technology to predict a little bit better. Because we say at CoreLogic, right, we don't predict, right? So we estimate, we model based on things that have happened. Earthquake happens, hurricane is happening, about to happen, happened, right? We can work with the data that's available, observational data, and we can recreate footprints, come up with loss estimates. But if you could say 5 days ahead before landfall, saying we're looking at a $5 billion event or a $50 billion event, right? Then you can answer a lot more questions ahead of time. And as long as those models, those, the artificial intelligence applications are accurate, and it seems like they're getting better and better. It's a very young industry, so it will grow. There are a lot of great things that can come from that.
Very much so. I think I read this. I'm going to forget the name of the book now, which is awful. It's a really good book on data science, and they were saying about the level of accuracy and speed of improvement of that. And it's probably about 5 years old now. It was a really good book at the time, but I'd be really intrigued to see an update on it, because I think that's what they were waiting for. And they were just basically saying, essentially the number of variables in weather and what impacts weather is so vast that it doesn't matter that we're 500 times better than we were. We're still inaccurate a lot of the time. So it's like, it feels like we're on the precipice of being so much better than that and being a really quantum shift. So has an exciting impact for risk, insurance, risk management. And it's not often we get to say that we can be excited about these things. Well, we do. We're in a safe space. We're allowed to be excited about insurance on this program.
I love nerding out about the insurance world. I've been in this game for, I don't know, only about 8 years now, right? And and this was not my first career. And having moved into insurance cat modeling, catastrophe risk analytics, like there's some cool things happening, and it's a lot of fun to just kind of geek out about.
Yeah, I agree. I agree. I was proudest of one of my team that's only been with me for about 6 months now, and they were watching a news report, and they were basically telling their family about the impact of that on a kind of the insurance basis, and they were sort of
Yep.
met with blank looks, and I've never been prouder. Never been prouder. John, it's been a pleasure. It's a really, really interesting conversation. We'll put the link in the show notes, but if someone's looking it up, you can find it on the CoreLogic site, Sahara Port 2024. I did it earlier today. It's very easy to download, so you can go find it there. But we will put a link. I really appreciate you being a guest on the podcast. It's a genuinely interesting conversation. So thank you very, very much.
No, thank you, Alex. I really appreciate being here.